Eduardo, are you back with us? Yep. Doug, good to see you as well. If we can get those cameras on here in Zoom, that would be phenomenal. We'd love to see your face so we can interact with you again today. But if you can't, it's all good. But if at all possible, we'd love to have you turn your camera on. But welcome in everybody in Facebook world and everybody in YouTube as well. We're so excited for you to be tuning in with us tonight. Day one, we laid the foundation. If you remember, we laid the foundation with talking about the mindset of a successful investor, right? The mindset of a successful investor and trader. That day, I truly feel like was needed, was a must for the rest of the week, because yesterday we kind of got into the different strategies you can use and choosing if you were active or a passive investor. And let us know in the chat real quick, did you decide whether you were a passive or active investor? Let us know in the chat. Doug, Marilyn, Eduardo, everybody let us know. Bob, let us know in the chat. What did you decide? What do you feel like is your strategy? Chef Eduardo said active. Let me see. Who else? Bob says active. We got a lot of people that want to get the money, get the bag faster, right? Like Doc said yesterday. Get the bag, right? I love this. Mike says both. I got to hear from Doc and Dave if you can be both. I don't know. Maybe you can. But they said both over in Facebook world. So, hey Gabe, good to see your face. Tom's back. Good to see you all. But listen, tonight I want you all to tap in and stay locked in like you have all week. Get your pen and paper ready because Dave and Doc have amazing presentation for you tonight. I'm so excited. I've been learning every day. If you've been learning something new every day, just put a 1 in the chat for me. If you've been here, you've been learning something new every day, just put a 1 in the chat. I feel like this information is what they teach their students. So I'm glad that they're pouring this information out for us. It's really, really helping myself, and I know it's probably helping a lot of you all. Yeah, Doug put a 1 in the chat. I see you all, saying it helped you. So listen, what I want to do is today we have a lot in store. I don't want to hold up any time today, but I do want to encourage you. You are now at the halfway point. You are now at the halfway point, so stick the course. You officially made it 50% of the way. We have day 4, day 5, and we're done. So I want to encourage you all, keep going on this race. Keep pushing forward because the rest of the week is going to be the best of the week, and we need you all in the room. But without further ado, I'm going to go ahead and turn it over to Doc and Dave. I believe Dave's coming up first, and they're going to get today, day number 3, main session going.
Awesome, Mike. Thank you so much, guys. And it's hump day, woot woot, right? As they say. But this is, we're so excited to get to today because now we start really getting into things, right? Now we start going from the bottom of the pyramid to the top of the pyramid over the next couple days, going into the nuts and bolts of everything. So, hey, to answer that question real quick, you can be active and passive. I think I said this yesterday. I'm a little bit of both. But you tend to gravitate towards one or the other. So it's understanding which one you gravitate to more, right? And based on your goals and stuff. So we'll talk about that more as we get into this. Tonight, we are really going to dig in on the bottom of the pyramid. We are going to go in depth on our versions of the wheel strategy. So Doc's going to start out. He's going to take you guys all through the traditional wheel strategy so you understand how it works, the rules behind it, and everything. And then I'm going to show you the twists that we've taken to it and changed it to make it even more effective over the years. So, Doc, I'll turn it over to you and look forward to coming back with all the twists and turns. So go ahead.
All righty, everybody. Good evening, everybody. Doc here. And what I'm going to do is get my screen shared here for you guys. And there we go. Can you guys let me know if you see my initial slide here? Replace your income challenge. And make sure you can hear me as well, too. Okay, so we got looking good, looking good. All right, fantastic, guys. Okay, here we go. So I'm not going to be doing any trade recommendations tonight. Don't worry about that. So call off the lawyers. Day 3, we're going to be talking about the wheel strategy. So yesterday we discussed the income pyramid and how we stratified our approach to creating income. So for those of you, talking about the active versus passive, if you think about it, really the entire income pyramid is both of them. And really what you need to do is to kind of find the areas that you really like, find your one thing, and then build upon that. So today we're going to start with the foundational layer of the income pyramid, the wheel strategy. We'll get into the nuts and bolts of the actual income producing strategies. I know you guys are getting impatient. You want to get into the details and go make some money. The first strategy that we're going to discuss is this combination cash secured put and covered call strategy. When we put them together, it's called the wheel. So for many investors, this is the only strategy that you don't have to get wild. You don't have to be trading some, wild name strategy. Like there's some really crazy ones that are out there, like the jade lizards, and we've got the broken winged butterflies and all kinds of things, right? Just because it's got a unique name to it doesn't necessarily mean it's going to make you that much more money. It's just a different tool. I go into my workshop, I pick out the tool that I need to get the job done. So for many investors, this is the only strategy that they use, and they can create insane returns with the right market conditions. So here is kind of a graphic that I want to impress upon you guys. When we say the wheel, we're going to be starting off by selling puts, and we're going to do this again and again and again and again, as many times as we can. It's the simplest trade that's out there. But eventually, at some point, we will get put the stock. And this means that you're assigned on the obligation that you agreed to take. So you get the stock. So instead of selling puts, now you get the stock, and then we're going to turn right around and sell covered calls on it. We're going to do it again and again and again and again until at some point the price rises up and we get called out of the stock. It sounds bad, but it's not. It's a good thing. And that brings us right back to cash. We're 100% in cash at that point, and then we can go ahead and use that margin to start the cycle again. Maybe with a different stock, maybe the same ones all over again. So that's kind of what we're going to be talking about here. So profits from the wheel strategy come in several forms. There's income from selling the put and the call options. They're going to be at different times, right? We're going to start off by selling the put option. That's generally how you start the wheel, although there's different ways to start it. You can do what's called a buy right. And there was actually a condition lately that made sense for me to go straight into buying the shares and selling the calls instead of selling the put. But that's relatively rare. Most of the time, you're going to be much better off by selling the put, lowering your cost basis, and then turning around and selling the call option once you are put the stock. There's going to be capital gains from stock appreciation if you own it for some time, and if the stock goes higher in terms of price, and I've got plenty of examples to show that, then you get the capital gains from that after you sell the stock. So paper gains don't count, but you will get capital gains from the stock appreciation, which is a good thing. And then there's always potential dividends from some stocks. So some of them pay dividends. Just because it pays a dividend doesn't necessarily make it better, because that dividend price comes out of the stock price. So you have to, 2 steps forward, 1 step back kind of thing. Income from the wheel strategy comes from selling to open an options contract. If you haven't done it before, most of the time when you set up a new trade, you're buying to open, and then you sell to close out that position. Here, what we're going to be doing is sell to open. So this looks like this. It's STO, sell to open. And then to close out the position, either we're going to let it expire or buy to close. Buy to close. So get used to the new terminology. It's a little bit different. It's opposite from what you're used to, but it works the same way. Selling to open a put contract obligates you to buy the stock if the price is at or below the strike price by expiry, that expiration date on your option contract. Selling to open a call contract obligates you to sell the stock if the price is at or above the strike price by expiry. So what I want you to think of is, if this is the current price of the stock, so I'll just put STOCK here. If this is the stock price in the chart, you're going to be selling puts down here. So I'll put sell put down here, sput. And then up here is you're going to be selling the call. So you sell the calls above the current price, sell puts below the current price. And we'll get into some of the metrics here. When you sell to open any option, the cash from that sale goes directly into your account. It doesn't go to some middleman. It's not going to somebody that holds on to it for you. It goes straight into your account. That's your cash. You can do whatever you want to with it. As long as you keep the margin for the position, you can't spend all the cash in your account. You got to withhold some in order to buy the stock if you need to. This is why I don't like calling them naked put options for the trade. You may have heard the term naked puts. I don't like using that term because I think it's incorrect. It's really called a cash secured put. Cash secured put is the name of the put trade that we do. So strategy principles, start by identifying a stock or exchange traded fund that you really want to own. This is very important from a mental perspective. If somebody recommends a stock to you and said, hey, you got to do the wheel strategy on this one, your mind is always going to associate that with that other person that recommended it to you. And if the price starts to go against you, then you're going to panic and say, well, now what do I do? What do I do? Because you didn't really want to own that stock. You've got to start off by really wanting to own it. If you can just take this step, right, and make sure that you're not trading anything that you don't really want to own. And I know this by experience because I would get cold feet. You know, I'd sell a put on something, and then the moment that I'd get a red candle going against me, I'd be like, oh no, I better get out. It's bleeding red. And that was, you know, my initial lizard brain response to that. You know, this goes back to what we were talking about Monday. Until I learned that don't do this strategy on unless you really, really want to own something. This stock or ETF should be a quality trading vehicle that retains its value, is in an uptrend, and offers a highly liquid options chain. So there's, 8,000 stocks out there. There's plenty of, little small cap stocks that do offer an option chain. Like Joe's Ugly Shirt Company probably has an option chain, but just because it has an option chain doesn't necessarily mean you should be selling options on it. Pick the best of the best here, because they're going to have better liquidity. You'll get better results. You'll have fewer odd occurrences happening to you where you say, how did that happen? You never want to hear that. Determine the price target that you would commit to buying the stock shares at. I'm going to keep using this word commit because once you commit, you can't change your mind unless market conditions change. It's important that you commit to a price ahead of time. So do the math. Do you have the capital to buy at least 100 shares of that stock and not overwhelm your account? So if you've got a $5,000 account and you're trying to trade a $50 stock, you're going to eat up everything that you've got on your account. It's not a good idea. Can you sell a put option at that price at some future date to earn enough to make the trade worth it? Is the trade worth it to you to lock up your capital and to create that opportunity cost where you can't use that capital for anything else? You can't trade against it. Can't use that cash just because the cash is in your account. It is locked up. It's got a glass cage around it. Remember, you're going to tie up that capital as margin for a few weeks. So be selective before you jump into it. Quite honestly, what happens is you find over time, there's going to be a small number of stocks in your corral that you get used to. You know the chain, you know how they operate, you know how the chart works for it, and you just do them over and over and over again. And that's what I would recommend that you do. It will take you a little time to get to that point of being, familiar with these stocks, but once you get them into your corral, keep trading them again and again and again. That's what we do. So sell put options until you get assigned or put the stock. So you're just going to keep doing this again and again and again. Just keep going back to the well as long as the stock is performing well. keep going back to the well and sell puts. This could take several cycles. And the advantage here is you're earning income, you're significantly reducing your cost basis. This is the easiest trade on the planet, I swear. When you get a chart that's just doing this, you're going to sell a put and then it's just going to evaporate. You'll sell a put and it evaporates. It just runs away from it. It's the easiest trade in the world. If you want to learn how to get confident with what you're doing, learn how to sell put options in an uptrend. You're going to feel like King Kong. Eventually, the price will pull back far enough that you're going to be assigned or put the stock to your account. This can happen on, or if they're American settled options, which is what every stock is, every equity is an American settled options, they can assign you early. They don't have to wait until expiration date. They can assign you early if you're in the money. So now that you own the stock that you wanted to own, it's time to rent it out to the market. When we sell a call option, we're obligated to sell shares of that stock at the strike price that we sell it at. It's important that you're selling a strike price above your current aggregate cost basis. So this was a question yesterday, like what if my cost basis is up here? That's my cost basis. That's what I paid for it. And the price is down here. What do I do? Well, you want to see if you can sell at the cost basis, if it is at all possible to sell at that cost basis or higher. If you can't, there are certain things that you can do, but we won't get into that right now. So again, we're going to do this as often as we can. We're going to do this again and again and again. We're going to sell those covered calls until such time that we are relieved of our stock. Eventually, the price is going to rise above our short call option, and we are going to be obligated to sell 100 shares per contract at that stock price. Fortunately, this is why you never do naked calls. Please don't ever do a naked call option by itself. Trust me, the brokers won't let you do it either. They won't let me do it. So, not that I want to do it. I've only sold calls by having it covered by either an option or the stock. So we already own the shares, so we can allow them to be surrendered or called out at the price of the contract that we sold. We have now completed one spin of the wheel. We sold puts. We eventually got put to stock. Then we started selling covered calls, and we did that as long as we could. We finally got called out, and now we're back in cash. Yay! We can play the wheel strategy again with a new or the same stock, whatever makes sense. So depending on account size, you could be potentially playing multiple iterations of the wheel strategy. This is where I want you guys to be eventually doing. This is what Dave and I both do. So we're out there playing the wheel on things like silver and gold, and we're playing it on the S&P 500, and we're playing it on Palantir, and we're playing it on, maybe Apple or NVIDIA or MicroStrategy or something like that. So you've got you're carrying all these plates, you've got spinning and juggling, and you're managing your risk on each one of them. So now let's dive into the details on each active session. So that was more of a high-level overview on the mechanics of the trade. So now we're going to dive into the details. So we're going to start with selling puts here. My suggested trading rules. Now, this is not the end of the world. This is just what I suggest you start with. You can always tailor these to how you want to do it. Must be a stock that you want to own. I'm going to keep coming back to this point because I found that this is so important for your success. Size the position to be no more than 10% of your capital. Now, for those of you with a small account, you may have to bend this rule a little bit. So if you're trading like a $5,000 account, maybe you can find something that's going for $10 a share. You can sell puts on that, and that's going to eat up 20% of your account. But it's so useful to get started with something like this but I'm saying right now, just on as a general rule, if you've got a larger account, don't get overly heavy on your position size. What price will you commit to buying it at? You got to know this answer. So what price will you commit to buying it at? And you should be able to determine this from the chart. Determine where is a reasonable price to buy this at. Sell the put there. Wait for a pullback to increase returns at that. So once in a while, if I have a stock, this is just going crazy, it's just running away. Like Palantir is a good example of this, where it's so easy to just sell behind it. But ultimately, for every parabolic rally like this, you're going to have a hairy backside, right? So if you can wait for the hairy backside, if you can wait for that pullback, you will dramatically increase your returns because of the fact that implied volatility shoots sky high there. So it's going to make it a much easier trade if you actually do wait for a pullback. I generally will sell a put at no less than 25 to 30 delta. So in other words, I'm not selling puts at a 10 delta or a 15 delta. Sometimes I will go as high as a 50 delta. I will go right in there and play close quarters combat with the price and sell a 50 delta because that's where all the extrinsic value is. If the current price is right here, if you graph the extrinsic value, it looks like this. It peaks out right at 50 delta. So that's where all the fluff is at. And that's kind of where I spend most of my trading at these days. As I've gotten more experience, I'm playing closer and closer to the money because that's where all the fluff is at. That's where all that extrinsic value that you want to sell is. So if I do a 30 delta, that means that I have a 30% chance of assignment. That's just the math based on the options chain showing. So start with ETFs until you gain experience. Don't go immediately into stocks. You gave away my homework stock. Is this making sense to everybody? Does anybody have, if anybody has a specific question, go ahead and put it into the chat room. I won't get to it until the end of the session, but I just want to take a pulse with you guys and make sure that this is working for you guys. So if it's working for you guys, just go ahead and put a 1 into the chat room. Okay, I'm seeing 1, so I'm going to keep on going. But if you have a question, go ahead and put it in there, and I'll circle back to it later. Okay, so let me show you a quick example. Well, just really, really quick, Chef, if you have a delta 30, so if delta is 30, which is 0.30, this is also approximately 30% chance of the price being in the money at that strike price by expiration. So the market's always working with probabilities. This is why it's not gambling. Okay, example here. I'm selling SSO puts, which is a derivative of the S&P 500. So I like using this because it's cheaper than buying the spiders. So what I wanted to do was I want to own the S&P 500. I'm totally cool with owning the S&P 500. So I sold the 17 Jan $85 puts, which is right down here, for $1.40 a piece, or for each contract, that's $140. So I said, I will commit to buying 100 shares per contract of the SSO down here at this price. The price was doing this that day. It was going all over the place. So notice that I waited for a pullback. Yes? Okay. So I thought that was a reasonable place to sell that option. And I forget exactly what the delta was that day, but it was probably close to 30. 2 contracts at $1.40 means that I brought in $280 of credit. My obligation was to buy 200 shares of SSO, 85 apiece, which is 17 grand. That gives me the potential to make $280 divided by 17 grand, or 1.65% return over the course of a month. So let's check on January 17th. Remember, I sold this position on this day right there. and I was obligated to buy the shares down here if it ever got down to there or less than that by expiration. Well, what did it do? It didn't do much of anything at all, and it actually bounced above that. So I did nothing for the next 4 weeks, which is, hello, passive income. And I let the options expire worthless this past Friday, removing my obligation and allowing me to use that capital again. So once the short options expire, the 17 grand of margins freed up and I can recycle it for my next short put wheel entry. So you want to set this up as a rolling thunder approach to wheel investing, right? So you're always letting something decay and expire, just constant rolling thunder. Always have something in play that is creating income for you. The more expensive the stock, the more margin is held back. It's good to start with less expensive stocks to tie up less margin. The most important thing for this trade is to start out committing to entry at that price. The second most important thing is to keep the position size small. Entering on a pullback will improve your entry. I recommend using ETFs to begin, which lowers your event risk. Highly unlikely for an ETF to go to zero. I will determine a price at which I no longer want to own the stock. This is my break point or I exit no matter what. So if it's crashing, if it goes below a certain price, I will exit the entire trade. Determine this at entry, not at 5 o'clock in the morning. Dave will show you a more dynamic form of defense in just a minute here. So now we're going to switch over to covered calls. When you sell a covered call, you're essentially renting out your stock shares. You're using an asset that you own, which is your stock shares, to collect income. Much in the same way that you can lease out rooms in a building that you own and charge rent for them. You can rent your car out through Turo and earn income from that. This is no different than any other leasing or renting arrangement. Here's my suggested trading rules. Use a stock that you already own, of course. You must know what your cost basis is on the stock. That becomes really, really important if the price starts to work down. I will sell a call at a strike price at or above my cost basis. If the core stock position is profitable, then I'll generally sell about a 30 delta call option. Can somebody tell me with a 30 delta call option, what are my odds of being called out by expiration? With a 30 delta call option, what are my odds of being called out for expiration? So answer this question. Do I want to keep owning this stock or do I care if it gets called out? Some people have been gifted shares of stock and they never want to ever sell them. All they want to do is they want to keep them as an income vehicle. So maybe you got shares of Procter & Gamble given to you or gifted to you into your account by your grandparents 50 years ago, and the cost basis was essentially $5. Okay, maybe you just want to hold on to those things and just write against them. Or if it's something like you just don't care about, there's stocks that I recently did where it's like, oh, I don't like this one anymore. I'm going to allow myself to get called out. So make that decision on a continual basis. Bob and Marilyn, you're correct at 30%. Always know your get out price. I would define that at the very beginning. At some point, you may find if the market is going through a bear move, you may not want to keep that stock. Here's a quick example. So what did I do? I've got these shares of SSO. Now, this is independent to the other trade that I did. But let's say that I was assigned on them. On this day here, I sold the 17 Jan, and this was on the 11th of December. I sold the SSO 17 Jan, 105 calls. The price was about 100. So I'm only giving myself about 5 points, but that's okay. My cost basis was $52 a share. $52 a share. It's 100 now. So I got these back in 2022. And these are sold at about a 30 delta level. Okay. So you guys know that now. So 2 contracts at 65 cents meant that I brought in $130 of credit. My obligation was to sell 200 shares of SSO if the price got up to 105. This gives me the potential to make about 1.25% return over the course of a month. What happened? I did nothing. I did nothing. Actually, the price dropped from here. So I was immediately profitable on the trade. And so there was no point in me recycling. I just waited for it to expire. I don't mind. I don't have to keep recycling that. Sometimes I'll just let things expire. So again, passive income where you're just not doing anything at all. So knowing whether or not you care about holding onto the stock in the case of potential assignment is key. Do you really want to own this? Are you married to that stock, or can you let it go? In the case of a price crash, knowing what your aggregate cost basis is mandatory. Are you ahead of the game or are you behind? Don't hold and hope. This will allow you to either wait out a pullback. I mean, we're going to get pullbacks all the time. You don't have to just dump because of a pullback. But if you know your cost basis is down here, that allows you to wait out a pullback and not overreact to it. You can wait this out. You can sell some puts down here if you want to. And then there you go. You're in good shape. You're going to see a lot of volatility if you hold a stock for a long period of time. You're going to lose your position if you get shaken out on every pullback. So I've just showed you some very simple vanilla setups. If you traded for any length of time, you're going to know that trade decisions rarely fit inside of a tidy little box. There's always going to be gray areas for them. And this is why experience is so valued. But I do find that most of the indecision goes away if you take the time to design the limits of the trade up front. Don't do it after you've entered the trade and all of a sudden you're in trouble and you're trying to figure out what to do. These are the types of decisions and discussions that we cover every day in my live trading room. So it's helpful to look over somebody's shoulder when you're learning and gaining confidence. So now I'm going to flip it over to Dave, and he's going to show you a twist on how he trades the wheel strategy. So Dave, I'm going to stop the share. You take it away.
Awesome. Thank you.
Thanks, everybody.
All right. Make sure everybody can see. All right. Can everybody see my screen? Just go ahead and type in the chat that you guys can see. You can hear me okay? Yes. Yes. Perfect. Perfect. All right. So real quick though, how about the wheel strategy? Okay. It seems too easy in some ways, right? It seems so simple, right? And honestly, it is very, very simple. The key to it, as Doc laid out, is having a disciplined set of rules and playing the long game, right? That's the key to being successful at the wheel strategy, the traditional way that it's done. But what if I were to ask you, would you like to not only do the wheel strategy, but also ensure that you are protected and effectively cannot lose? How many would like that, right? How many would like that? You can drop in the chat. Give me a 1 if you'd like that. All right, so we're going to talk about the 12-minute trading wheel strategy, right? That's what we do with kind of our spin on how we do this. Now, again, I think what's nice about tonight is you're seeing the traditional way and you're going to see this way. And it's kind of to each their own. So depending on what you gravitate to, depending on how you prefer to do things, you can pick either one, right? There are some benefits to both, right? And you'll see why here in a little bit. So the 12-minute wheel strategy, very simple, is you can enter it actually by selling a put or buying shares and selling a call from the outset. That's called a buy right. Doc mentioned that before. You're going to sell at the money. So where Doc's like 30 delta and all that, we're going right at it. We're playing the close quarters combat. We're going right at the money. And you're also going to be done doing it as short as 1 week, all the way up to 6 months, depending on whether you're active or passive. Shorter time frames are active, think. Longer time frames are passive. And it uses part of the credit to establish what's called a collar to protect downside risk. So why sell at the money, right? It pays the most amount of credit, allowing you to have extra credit so you can purchase that defense and establish the collar. Now, what is a collar? Well, a collar is pretty straightforward. You'll notice these slides from me tonight, I don't have a lot, but they're pretty text heavy. So those of you that are VIP, when you go back into the recordings, you can see it all listed out and everything for you, you know? So just bear with me on that. But a collar is an option strategy that's designed to protect an existing or newly purchased stock position from large downside moves by purchasing a put as protection. That's the traditional collar, right? We're going to flip it on its head because we're selling the options and we're going to do the collar as well. So how does it work when we're putting it into practice? Well, it's downside protection, right? You are buying that put to effectively establish a floor on how much you can potentially lose if the stock's price were to drop dramatically, right? So, Doc was talking about he sold that 85 call. What if the SSO for, the market crashed and that thing dropped to 50, right? What would he have done? He would have had to hold that for a very long time and then sell over and over again. Like he did in the crash. He had it for about 3 years, right? Now there's benefits to that. You're going to reduce the cost basis, as he said, and if you do it long enough, you get to a point where you effectively can play with the house's money, as I like to call it, right? So you've got your cost basis down to zero, and anything's pure profit. But wouldn't it be nice to have some protection in place so if that were to happen, right, you are protected effectively? And you don't have to do that. You can exit the full trade basically for break even and get out, right? And so buying that put, you're establishing that floor on how much you can lose or keeping yourself near break even if that price does drop. So it gives you the right to effectively sell your stock at the price of the put, and it gives some of that offsetting premium, right? So, selling the naked put or the cash secured put or writing a call option really generates the income, and then that income partially or fully is offset of the cost of buying the option. That's why we like to sell at the money, because you get the most premium. And then I'll talk about where we put that protective collar put here in a minute. So with the 12-minute trading wheel strategy, we sell at the money to get the most premium, and then we use some of that premium to buy the collar, effectively locking in our profit from the outset. Okay. All right, so I'm going to go through text of an example, but I'm going to jump into the options chains. We'll probably go a little bit longer tonight for all of you in Facebook, because I'm going to go through as many examples as I can get in the time that we have before we get to our Q&A with VIPs. But for a cash secured put example, you're going to sell the cash secured put. Let's just say that the company is at $50 per share, right? So you are going to sell right at it. And let's just say, for the example's sake, it generates $5 in premium income, right? And then I'm going to turn around. I'm going to buy, for every one that I did, I'm going to buy one XYZ 45 put, which is at the break-even stock price when I subtract out that premium from the price of the shares. So if I sold at 50 and I got $5, that means my break-even's at 45. Okay? And let's just say that's selling for $1. Okay, so this serves as that protection as it will go up in value. So if I bought it for $1, right, I know I'm taking a little bit of that credit I got, so it's not a true break even. But if that stock drops or that underlying drops, that dollar is going to go to $2, $3, $4, maybe $5 or $10, right? And so when that happens, that's what gives you the premium that protects you. So if you wanted to just exit the full trade, you could, and obviously not lose a dime. Next, you have the cost of the put, right? So there's the $100. And so the income from the sold put is $500. As I said, your net cost now is $400 that's in your bank account, right? So $400 per contract. And the setup ensures that your maximum loss is extremely limited, effectively to the break even, because you're selling your 45 collar put if the market falls below that level. I'll stop there. Can everybody follow that? If not, just let me know. Put a 1 in the chat if you follow that, fine. Put a 2 if you didn't, and I'll go back through it if I need to. Great. All right, we got a bunch of ones. Thank you. Excellent, guys. Okay, now let's flip it on its head. Let's go with the covered call. So in this scenario, we're going to come in and we're going to buy the 100 shares at $50 per share, right? So that's our cost basis, right? That's where we're at. That's our floor from the start, $50 a share. We're going to turn around, we're going to sell at the money, which is we bought it at 50, the money's at 50, we're going to sell that $50 call for $5. Same thing, it generates $5 in premium. Options trade in 100 share blocks, so per contract that's $500. And then I'm going to turn around and I'm going to buy one $45 put. Again, subtracting that premium from the price that I bought it at to get to where my break even is. And let's just say it's selling for $1 again. That put's going to serve as the protection the same exact way. It works the same exact way from here, right? The cost of the put, again, is $100. The income from the call is $500. The net cost is $400 in income that you get. And the setup assures, again, that your maximum loss is extremely limited to around your break even because of that $45 put going up in value if the price comes down to it. All right. With that said, there's some very important keys to maximizing the 12-minute wheel strategy. You got to buy, okay, the put at the break-even strike, subtracting your credit from the share price. You don't want to go lower, right? You don't want to sell and get $5 on a $50 trade and buy the $40, even though it's cheaper. You got to be at your break-even. You never sell your collar put early. So let's say this you've done a trade 3 weeks out and immediately that stock drops and all of a sudden your collar is making a lot of money, right? Problem is if you sell out and take it there and the stock continues to drop, well, you're putting yourself into a losing position, right? So this is something you must leave on until expiration or when you decide to exit the entire thing all at once. Okay. Very, very key. And it's weird, right? Because sometimes you'll have that stock drop and then it'll come all the way back, right? By expiration, you'll win the trade, but you didn't use that. You could have sold out, right? I've done it before, and more often than not, I've gotten myself into trouble because I sell out of it, and then I either got to get back in and more expensive, or the stock continues to drop, and then I got to deal with, holding shares and stuff like that, right? So it's just easier to hold it until expiration. And then if it's in the money at like 2 p.m., 3 p.m. on expiration day, that's when you sell out of it. You get put the shares, right? Or you buy back your call for real cheap because maybe it's worth 10 cents now and you just sell out of your shares and exit, or turn around and do it again, right? We'll get to that in a minute. But if the stock drops, you stay in until expiration. Like I said, you want to wait till the last day and the last few hours of expiration to exit so you maximize the benefit. If you're going to exit the position on the last of expiration, you're going to exit all the trades at once, right? So you want to sell out of the collar and then immediately you want to buy back the naked put or covered call as close to the same time as possible to ensure there's no fluctuation, in your break even, your profit or your loss, right? Additionally, if the trade goes against you and you do exit getting the additional collar premium, that allows you to set that new break even level on your shares. So let's just say I got $5 originally. I bought the call for $1 or the put, I'm sorry, for $1. Stock drops, down to, I don't know, 32, right? And all of a sudden your premium that put is worth is 12 or 13 bucks. Well, if you sell out of that, right? Now you can effectively reduce your cost basis down another 12 or 13 bucks, turn around, sell that covered call at your break even, do it all over again, right? So that's how the traditional wheel comes into play when you have this happen. Again, over time, cost basis can be lowered using the strategy so that your stock would effectively go to zero. And then really it's pure profit. The rules, okay? So again, like Doc, these are suggested rules. You can, play with them how you want, your variations of them. But you're going to pick the stocks that you're okay with owning a minimum of 1 year. If you're going to be an active trader, you're going to sell in cycles 1 to 3 weeks out. If you're more of a passive trader, you're looking at cycles 1 to 6 months out. You're going to sell either a naked put or covered call at the money for your entry to maximize the premium for the option cycle. And you're going to buy the collar put at the break-even strike, subtracting the put or the call premium that you got from the sold strike, right? Or the price of the stock that you purchased it at. Your goal is to keep a minimum of 50% of the credit received after buying the collar. 60% is ideal if you can get more, that's awesome. Once in a trade, do not exit until expiration day. The only exception is with a naked put trade. If the stock or the underlying goes screaming higher and you can buy your sold put back for, pennies or real cheap, ensuring a nice profit, then get out. Close everything out, right? If the price does go against you, your collar put serves as protection. You keep it in place until expiration day. You look to exit the entire trade at once as much as possible. And then you want to keep track of that cost basis to establish the break even for selling the next cycle and so on. And then lastly, if you can, avoid holding over earnings if possible. I know it's tempting. We watched Netflix go up 10% today. If you had sold an at the money put on it, you'd be out right away, right? But you just never know. It could have gone 10% down the other way, right? So you're better off waiting till after earnings, or maybe like selling right before earnings if the stock's maybe running up to it and stuff. You can take advantage. I'm going to show you, like Tesla is getting ready for earnings, so I'll show you an example of that coming up. But it's better to just let that all kind of calm down and then get into it. So, all right. So, what are the risks, right? Trading with the collar limits the risk to, effectively your break even if the stock really drops, but it also means that you make less credit, right? Because you're giving up some of your credit to buy that, right? The insurance is worth it. We're talking about being a one-person insurance company. Why wouldn't you want to insure yourself for your trades, right? Insurance companies have insurance. The underlying could end the option cycle above your protective collar, but below your sold strike. Now it's great for covered calls because that means you keep, it effectively expires worthless. You can turn around and you just sell another call at your break even, or right at the money if you want to again, if your break even is, below there, and or above there. And then you can turn around, set up the collar and do it all over again, right? So that's really nice. Now, if it's a naked put though, you're gonna have to get put the shares at wherever it's at, right? So maybe in this example it ends at 48, right? And you get put at 50, right? You got your cost basis, and your cost basis is around, well, $4 was left, right? 46. So you could sell right at the 46 in the money and do it that way, or sell right at the 48, right at the money. Keep it a little higher, right? But you want to ensure you got enough premium to buy that protective collar again. But sell that new covered call trade, either again on the shares you own or the newly put shares, do that process over again. Does that make sense to everybody when you look at it from both sides like that? Do you understand kind of why having a collar helps you, right? It helps to take some of that risk off the table and helps give you some of that extra insurance. So let me make sure, guys, put a 1 in there if you got it. And I'm going to jump into the trades here and just really want to spend the time with you going through that. So excellent. All right. So I'm going to jump over. Here's the first thing I want to do is just talk a little bit how we look at things on the charts. Okay. Now I'm going to start with Tesla. It's not the greatest example because it has earnings next week. So I won't be trading it right now, but I can show you at least the mechanics of things. Now, here's a stock like down here, right? Kind of what Doc was talking about looking for. That's where you like to sell, right? Into a bottom like this. We're in the middle of the range, right? So it can go kind of either way from here. And so it's one of those things like if you're going to do it, you got to have the collar because earnings coming up, it could go either way, right? It could go screaming higher, it could go screaming lower. So if you don't have the collar in place, you really would put yourself into maybe a bad situation if you're just doing the standard sell the put, right? If you don't mind owning it below being underwater, that's fine, but that's kind of the bigger risk you take around earnings, right? So, but here is where it would be nice. This is what we want. We want to see it come down to the lower end of the Bollinger Bands if we can, find good support, start to go back the other way. Good time to sell. For now, we'll just say, hey, it's at 415, right? Now I'm going to jump over to the options chains and just show you what this looks like 2 weeks out, and then longer term if you're more of a passive trader. So here are 2 weeks out effectively on Tesla. You can see if I come and sell at the money right here, I'm going to get $2,400 per contract. Now, yes, Tesla's a $400 stock. Don't worry, I'm going to show you some $3 and $5 stocks here in a little bit. But effectively, if I did this with one contract, here's what it's going to look like, right? So I'm going to get $2,000 plus dollars, but my buying power effect, right? It's 38,000 is what it's going to take for me for doing this, right? Or set aside, if you will. So, okay, I've done that. Now, where's my break even, right? So my break even is I'm at 412 if I do this, right? That's the closest to the money. Minus 24, that puts me right down here, the closest strike, probably about 385, 390. So I could come in at 390 and buy my collar, right? So if I buy my collar, I'm going to buy single, buy one of them, and it's going to cost me $1,400. So what I've done is I've effectively set it up so that my profit on this is going to be $1,000. If Tesla drops like a brick, this thing's going to all of a sudden go up in value, right? It's going to go from 14 to all of a sudden it'll be worth 25, 30, 35, right? And I'm protected, right? For if it drops like a brick. And if it doesn't, right, and Tesla goes higher, I made $1,000 per contract. Now, the way that I do this strategy, the way I like to do it, is I'm after an income goal on a weekly basis. So for me, with this strategy, I want to make $2,000 a week. So I've got the money. If Tesla, I think, is the best setup for that, I'm going to just do a couple contracts on this, and that's it for the week for me, right? If there's another one that makes sense, I'll do that. But I'm taking into account that difference between my defensive collar, right, that I'm putting on, and what I'm getting for the trade, so that I can make sure I'm hitting my income goal, right? I don't. A lot of people look at percentage, right? Hey, I want to make this percent, that sort of thing. For me, it's just about what dollars that I want in my pocket each and every week to hit the goals that I want. So, with all my strategies, I'll target a specific income goal per month, right? So, good question. I saw that come in. I was going to tackle that. So, do I enter the orders manually or sell vertical? I enter the orders manually. Here's why I do it. It forces you to be disciplined. Because as soon as I sell that put, it's going to set aside the money in my account. If I do it as a spread, it's too tempting to do more contracts, because if I come in here and I do this as a spread, watch, sell, vertical, and I do this, all of a sudden I'm making $10, right? Which, again, that's what I'm making. But I'm looking at this going, hey, it's only 12 grand. Oh, I can do 5 contracts. I can do 6. Well, guess what? If it goes against me, that spread's in a losing position. And I've got to have the capital to effectively take on all those shares and sell out all those protected puts. And so it forces me to be disciplined, to just do the right amount of contracts for the amount of money that I have and want to allocate to it. So that's why like I talked about yesterday, spreads can be really addictive because of the profit potential with them comparatively. But the issue really is that the minute you think you're invincible and you start ratcheting up is when the market turns against you and you blow it up. I had that happen with me years ago with Google. I thought I was invincible and came into expiration day at almost full profit. And by the end of expiration day, I was negative $75,000 in the hole. And I had to roll those things for the next 6 months to get out of them. Don't ever want to do that. So I like doing it that way because it just holds you accountable. All right, now let's take a look at the other side. Okay, so let's say, hey, we're at 415, right? Now I could have sold the 415, right? 415.11. I could have sold that right there and gotten, a little bit more, right? Which would have been fine. But 415 call, right? So effectively, I'm buying the shares, right? So I'm going to buy 100 shares. It's going to cost me $41,500. It's not going to show that in here because I have margins, so don't worry about that, but just pay attention to this number. Cost of trade, $41,511, right? I'm going to turn around. I would turn around and sell this on top of it, right? It's going to pay me $2,695 per contract. I would again subtract the 2,695 from the 415 that it is, and that's going to put me down again in this range. Same thing, right? Now I'm making a little bit more, $11 or so when it's all said and done, but same thing, same setup. I'm all set for it. Same principles apply if it drops against me, all of that. The only benefit to doing it with the call, and I do a lot where I just do it with the covered call and own the shares to start. The big benefit is if it does drop like that, you can actually buy back your call cheap and follow it down. Okay. Now this is a little bit more advanced, but let's say this thing does drop down into here and your call goes from 27 to $10. And you can buy it back and come down to like the 405 now and sell the 405 at the money, and that's paying $25. You still got your put hedge in place, right? So you can continue to follow that down and reduce your cost basis and collect premium, right? You're going to get taken out when it goes back up. But if you're okay, if you're managing, kind of where kind of what your money is and how much you are keeping in credit overall, that's a nice thing that you do have the ability to do with this. But that secured put is the anchor. That thing stays in place the whole time because that's your ultimate protection. And that's why I said, like literally 3 p.m. hour on expiration day, that's when you exit the thing, right? Because that's when you maximize the value of it. And if the stock can continue to drop, it's continued to go up in price. I had this happen with Coinbase a while back where I had it in place and Coinbase dropped tremendously. And on expiration day, that put was worth like $50. My cost basis on Coinbase from doing that one trade was like 25% lower than where the trade started. And I actually eked out a nice little profit on it, turned right around and then sold the put because it had dropped so much and did the collar, it ran away from it, and I was out within a week with more profits. And that's kind of the beauty of it, right? So you can play both sides of the stock no matter really what's going on and really make some money. So that's one with Tesla. So now that we kind of understand a little bit of the mechanics of it and stuff, let's just look at some other trades, okay? So I'm going to jump over. I'm going to pull up a few more. Let's find, here's one that's got very rich options. It's called Upstart, okay? So you can see if I go out to February, 7th, $3.60, I'm getting, and I can turn around and come down here and buy for two bucks or so. So that's knocking in about $1.60 for me, protecting me. If I go out for, let's say, to June, maybe I'm longer term, it's paying me 13, 14 bucks. So I'm down here buying the 50. I'm making $7, $8 on this one, really, and I'm protected for the next 6 months on this thing, right? So that's you find that a lot of opportunities like this. The longer out you go, obviously, the more premium you get. If we want to get really crazy, we can look at MicroStrategy. So MSTR, if you want to go out to June and you want to do this, you can see you get $84. So that actually, your break even from the minute you do this is down here at 290-ish, 280-ish, right? So you're locking in 5,000 bucks per contract doing this one, right? And if it drops down to there, you've got your put to protect you. And if it keeps going, great, you're going to get an effective cost basis on MicroStrategy down here, maybe, right? Who would love to own it? Now, longer term, like if you want to do doc strategy on this, you still can sell it like 330 and do pretty good too, right? Get assigned. Your cost basis on that, you're down to 270 just by doing that. So that's why MicroStrategy, everybody trading it a lot and everything because of the richness of the options change. But look at the expected move for that time frame. This stock is expected to move, and this is always on the options chains at Thinkorswim. This tells you what this stock is expected to move by during that time, plus or minus 244 points. This thing could be $100 6 months from now, or it could be $700. So you got to understand that, right? And that's why, the protected put is needed with a lot of these stocks. Now, for somebody with a small account, here's an oldie but goodie. Rig. Okay. Rig's been around for a long time, Transocean, right? So if I wanted to do the same strategy on here, buy, I don't know, buy 300 shares, that's only going to cost about $1,100 on this thing, right? And if I'm going long term, I can sell at the money. That's a 45 call, so I can sell that, right? And or sorry, a 45-cent call, just about, and it's at $4 a share. So if I'm, risking $1,000 and I get $150, that's a 15% return on my money. And if you notice, it's really cheap to come on the backside and buy that put right here. So you're effectively locking in a little over 10% for yourself on this thing if you did that. So so that's just an example of a really cheap little stock. Another one that is pretty cheap is Riot. I mentioned this yesterday. Riot's a miner. Again, Bitcoin, it's got nice options chains. This one's great to trade shorter term too. You can sell at the money, right? 13, come down and, basically buy again right around that 50% mark. Maybe, right here at 11 and a half, you could do it, but you could buy right there, lock in $50 on a $13 stock, right? Or you could sell the covered call, get a little bit more in some cases. Um, Another one that's pretty hot right now is Rigetti. This is another one we've got trades on this right now in our account. So this is one of those stocks that is quantum computing. It's actually had a really nice pullback, so I've actually been selling on it a lot lately, and doing pretty well. So in fact, on our account today, I sold the 13 this morning when it had come down. It was right at 13. I got about $2.20 on the 13 today on that, and I turned around and I bought the 11 put there. So I locked myself in for a nice few $100 for the next week. Just did it out a week on this one. So that's an example of another cheap little stock, right? Um, I've got a number of I wrote down here. Now, if you want to go a little contrarian, UNG. So UNG actually pays out pretty well. It's natural gas. Doc and I trade this as well. This is actually one that we wheel all the time. In fact, I've got shares on it right now that I actually you see them right up here for this week. I actually am in the money. I have the $14 put sold, and I've just been rolling that put. And every week I look and see if I can roll it and make more money, and it's paying me money. So as long as I can make some money and just roll it in the money, I will. This is traditional wheel. So it wasn't with the collar or anything. And our cost basis on that thing is down to, gosh, $8 to $9 now. Been doing it for about 8 months. And so I can let it be taken at 14. I'm doing really well. But hey, I just keep rolling it. Makes me, another few $100 every single week that I do it, even being in the money. And then when it comes back down, which it will, it'll move pretty good. One of the best places to sell on it is around 14. So, and I misspoke. I have the call sold at 14. That's why I keep rolling it. So another, good but cheaper one, playing a little contrarian too, because natural gas, it's actually an uncorrelated asset to the overall markets. This may be one of the best uncorrelated asset to the overall markets, actually. Um, See if there's any others that would be nice just to show you guys, just to give you an idea. Oh, IBIT. So you want to trade Bitcoin then without buying Bitcoin. This is probably the closest thing today. So again, you can see there's a lot of money in the options chains on this. Now, sometimes it's going to be hard to get that defense. You can see that here. Even if you sell the call and buy the shares and sell the call, $3 lower than, 58.50, you're down into this range. So you can kind of make it work. It's about 50%. There is another way to do it, but you got to really take this into account, your expected move. So everybody's familiar with the put spread, right? So I could come down to 56.50 and I could buy a put spread as my defense. Spend a little less money. Maybe I want to buy to 52, right? Protect myself. So that's outside the expected move, right? And I'm spending a little bit less money. The only issue with doing a put spread is if that thing drops below 52, you're going to make all the money on your put spread, but it's not protecting you all the way. So if you decide to use a put spread to go cheaper, even though you're outside the expected move, things can move outside the expected move. So you just got to know that, hey, that's part of the risk I'm taking, but my cost base is going to be lowered to roughly 52, right? If that happens. And then that's where I sell my call, right? So that's another way to look at it. So, this is a great way if you really want to start playing into Bitcoin. If you go out further on this, like just go long term, here's May, some good premium in these chains, right? Especially, you got a little bit more skewed to the call side. So, you do this at 58, you make $7, you're going to go down to 51. That plays out pretty good. You're keeping about, close to 60 or, 50% of that credit or so, right? If you do it with a covered call, you're making a little bit more, maybe about 60%. So that's the wrinkle. That's the rub. So I'll stop there. And I know I'm a little bit over our normal time, but if there are any questions, Michael, if you want to come back on, if anybody in the Facebook room has a few questions, we can take a minute or so to do that, and then we're going to jump in with the VIPs and go more in depth on this.
And let's see if we have any questions. Did you all find value in that session? Let us know in the chat. Let us know in the chat if you found value in that session. Let me see. Janice, good to see you over in Facebook world. Frank, good to see you. All right, Marilyn, love that session. A lot of value. I was like, man, Dave, can you teach us any more? Doc, can you teach us any more? We going deep. I love
This is
this.
just the
I
beginning.
love this information. So let's go ahead. Let's stop your share screen here, brother. There we go. All right, cool. So are we going Sonny wants to know, Dave, are you going to start suggesting some trades that we can do next week?
Uh, yeah, we're going to talk about a few of those over the next day or so. Um, and obviously VIPs, we're going to get more of those. And then obviously our students get our trades every time we do them. We give our trades out as we do them or even before we do them. So, but yes, before I'm done, you're going to have a double double and a 50-50 to try out. You can do any of the ones that I just showed today on your own, right? And you understand the principles and how it works. You can go to town. Remember your homework from yesterday? What was your homework from yesterday? Facebook group or in the chat here in Zoom. What was the homework? All right, so the homework, right, was to go find kind of your list of stocks, those ones that you want to sell on, right? I see, yeah, Palantir is one of those, right, Melissa? And some of these others, right? You've got your list. Well, your real homework today is going to go start, if you can paper trade these things, or at least do a simulated trade. Go out in the market tomorrow when it's open, right? See how it would work. You don't have to finalize the execution of the trade, but you can put in the order, see what it looks like. That order book comes up, and get an idea for it, right? And then go see what it would be if you're going to do, the wrinkle, right? If you're going to throw the collar on, what that looks like, what your net, premium is, your credit is for that, and just get a feel for it. If you can use like the Thinkorswim paper money to do it, I would suggest go to town, right? Put on 20 or 30 positions, right, with your play money. Have some fun with it. And just test it out. Start to get a feel for these things.
I love it. I love it.
Doc, anything
Great
you want to
homework.
add to, yeah, I'll
No,
say, Doc, anything you want to add to what I shared or just in general here?
Yeah, if you guys do a bunch of trades, make sure you take notes on each one of them, because each trade should count towards your overall aggregate, your practice. And if you just shotgun it in there and you don't pay any attention to them, and a month later it's like, hey, look, I won all these things. Well, yeah, that's great, but you didn't really win. You didn't really learn
Yeah,
anything during that. So
ideally, you should track every trade.
track everything that you
So
can.
I'm gonna give you an example of that. Okay. So let me do something here. All right. So this is an example. We're going to get into this over the next day. This thing got too big. Um, we have tracking sheets for every single strategy that we do. Okay. Every single strategy has its own tracking sheet. So like here are my 50-50 trades for the year. So far, I am 100% winning, right, on these. And I'm going to get in the mechanics of these trades, over the next couple days or so. But so far, in the first couple weeks of the year, I've got a little bit over close to $1,000 in winnings on these trades. So we're going to get into this over the next day, but we have a tracking sheet that literally rolls up to total profit for all of our different trade strategies. So every time we do a trade, we go and we update. And Doc and I have one for our own, our fund account where it's online, where we both can get to it in Google Drive and go do that. So, this is just for one of my accounts, but I keep one for every single account. And so keep track of every single trade. So students get access to these trackers and all that stuff from us and everything. You don't have to reinvent the wheel. We've already invented it and done all that stuff. So we can give it to you. All right. Any other questions out there, Mike? Otherwise, we'll jump into VIP.
My bad, y'all. I keep forgetting I'm talking on mute. I'm talking on mute. All right, yeah, so let's go ahead and we'll close it out for the main session. I apologize about that. We're going to go ahead and close out for the main session. So if you are here and you want to jump into the VIP with us all, we're going to have a great time over here in the Zoom room. Remember, there's still time for you to upgrade. You can go, the team's going to drop the link inside of the chat for you to click. We've been doing VIP Q&A all week. Plus, you're going to get extended access to these replays. So go ahead and click the link that is in the chat. I know VIP is probably going to have a ton of amazing questions that we're going to go through. I think yesterday we went a little over 30 minutes of just straight Q&A. So we would love to have the general admission join the Zoom with us by upgrading to VIP. But regardless if you choose that or not, show up tomorrow for day 4. We're going to start same time, same place as we kick off day number 4 of the Replace Your Income Challenge, right? So everybody give it up for yourself. Give it up. You made it over halfway through the challenge. Make sure to go create your paper trading account. Go take action and come back tomorrow and let us know what progress, maybe what walls you hit. I don't know. Maybe you'll find some big wins in your paper trade account tomorrow. So bring that back tomorrow. Let us know how it goes. Track those trades. But let's go straight into Q&A time with Dave and Doc. So I'm going to go ahead and turn it over to you fellas, and let's rock it.
All right, guys, it's all you. So any tickers you want us to take a look at, any questions about this, we